property? What are your options if you have 100 grand in the bank? So these are the kind of questions we'll be covering. I'm joined today by three fabulous experts, and I'll be introducing you to them shortly. Helen Chorley, Matt Siddell, and Mike Frisby. Let's just see who's what. Oh, we've got people from Slough watching, Stockport, that's far away. We've even got Norway mentioned here. That's nice. Thank you very much from Norway. High Wycombe, West of England, Somerset, Brazil. Wow. Wow. We've got a few far-flung places. Nice to see. West London. Good, good, good. So keep your comments and all of that happening in the chat window. The chat window is really for you to kind of network and banter with each other and say whatever you like. Now, if during the discussion you want to get a question to our panel, you basically want to stop proceedings and have your question put to our panel, then basically hit the super chat button. There's a super chat button on the side, on just to the bottom of where you see the chat on YouTube. I think it's a dollar icon. Hit that and do a super chat, and we'll put your question straight to our panel. So I mentioned our theme tonight, a little bit about, oh, it's been a busy week this week, hasn't it? Now, I thought that I was just some random guy on YouTube doing a few videos here and there. But to my surprise, my delight, if you like, I wake up on Sunday and see our YouTube channel, this very channel, quoted as an information source by the Sunday Times, nonetheless. So what was all that about? We produced a whole bunch of videos on bounce back, using bounce back loans for property businesses. Now, some YouTubers on other channels have been giving some, I feel, very inappropriate advice on the subject, and this was picked up on the Sunday Times. And they quoted our channel and what we were talking about as being a sort of trusted source. So I was quite pleased with that. We'll have some links in the description on the bounce back loans video if you want to check that out. But if you don't want to read it in the Sunday Times 3 or 4 weeks later, the best thing is to make sure you subscribe and hit the bell icon on this channel, because we put out new content each and every week, all dedicated to helping you be more successful in property. Got more and more people joining us. Oh, you've got the Sunday Times pick on there. That's nice to see that graphic. Brilliant. So let's just go straight to hearing a little bit from some of our panelists. Let's start off with Mike Frisby. Mike Frisby, I've known for, God knows how many years, actually, more than 15 years, bit of an HMO supremo, an all-round investor, developer, and good egg. Mike, thanks for joining us tonight.
Good evening, everyone, and thank you for inviting me on, Ranjan. It's a delight to be here.
So give us your elevator pitch. What have you been up to in property? And
what have I been up to? As you said, well, I've been investing in property over 15 years. Obviously, I came across you fairly early on in my property investing journey and was lucky enough to learn a bit from yourself. So started out, investing below market value properties, trying to find deals, and really grew my portfolio. And I grew my portfolio pretty fast. That allowed me to escape my corporate world. I started off in marketing and strategy, working for big brands like Guinness and Unilever. And then since then, I've been really focused on income and been through various different strategies on that, around social housing through the last recession, and more recently on HMOs, and also doing title splitting. So I've done most things within residential property, and I generally buy to hold. I'm an investor. I'm a property hoarder, I call myself, rather than doing lots of development and flips. So I like to keep them a bit like yourself. I like to keep them, hold them for the long term, and live off the income that's coming from the properties.
Brilliant, brilliant. And secondly, we've got Helen Chorley. Helen and I are doing a bit of telly together shortly, once COVID's over and we can get filming series 2 of Property Elevator, which is a show a bit like Dragon's Den, but for property investors. Helen, tell us a little bit about yourself. Thanks for coming back.
Oh, thanks, Ranjan. I enjoyed myself so much last month. Yeah, it's nice to be back again. I'm a private investor. I fund kind of developers deals. I don't develop myself. That's just kind of too much hard work, and that's not where my skill set is. My background was in banking, investment banking. I worked in the foreign exchange foreign exchange trading floor of a large American bank for a long time, till I burnt myself out spectacularly, and then kind of took those skills of kind of analysis and the number crunching, looking at that type of stuff, and kind of applied it to property, which I'd always had a love for anyway. So I fund other people's deals. I do some crowdfunding, I do some direct, kind of a mix of strategies. So I'm really excited that we're going to be talking about kind of the whole range of options for people tonight.
Yes, we've got a lot to cover. And you're stranded here, are you? Because of this COVID crisis?
I am. Actually, it's because I got stranded here because we were filming the promo for Property Elevator. Yes. I came over in March and we filmed that, and I was due to fly out the next day, and Malta shut the airport, so I couldn't go back. So I spent lockdown in the UK. So I managed to get a bit of a tan, which is quite a good thing. But quite desperate to get back, really.
And Matt Siddell, thanks for joining us. Your first Baker Street live stream. And
my inaugural Baker Street, my inaugural live stream as well. It's very exciting. Got 350 people online, so I'll try not to disappoint. But I bought my first property in 2000. I actually bought some buy-to-lets in the last economic crisis. I bought a flat off Barratt, 20% discount, and a flat off Bellway. Those actually turned out to be two of the best investments I've made. I bought a load of houses in Reading before Reading appreciated. I was investing in developing HMOs there. I've done developments in London. A couple of years ago, I started Candor, spelt with a Q, which is a club for business owners and investors in property, doing deals above £1 million. So actively involved in deals above £1 million. And that means I work quite closely with a lot of investors and developers. I hook them up and watch them do deals together, and crowdfunders and other people who are in the network to do business together. And the last 6 months, I've been working on Tropolis, which is quite a disruptive training platform for people who want to learn about property. And I launched that right at the start of the lockdown. And I've been working hard on that for the last few months, and it's going very well. But I'm excited to be here, and thanks for the invite, Ranjan.
Brilliant. Good to have you on board. And I'm your host, Ranjan Bhattacharya. I've been investing in property for about 30 years, do residential, commercial developments, all sorts of stuff, mainly around London and the southeast of England. I'll be kind of chipping in here and there and prompting the others to hear their views in the main. If you want to hear my views, there's plenty on this channel on all sorts of areas of property investment. So just make sure you subscribe, like, and all that jazz. Right. Okay. So let's just get straight down to it. The COVID-19, of course, is a little bit unexpected. After we had the election uncertainty last year, didn't we? And Boris won and all of that. And there was a massive bounce. We were all kind of very optimistic, and things were booming. And then all of a sudden, COVID-19 hit. There was shutdown. It's the biggest jolt to the economy that any of us will have ever seen in our lifetime. Some economists are talking about a 25% drop in GDP. It's just come off a cliff edge as we've gone into shutdown. To put that into perspective, even in the Great Depression in the 30s, it was only 8 or 9%. And the 2009 thing was about 4%. I think one of the big differences this time round has been the way the government has tried to shore things up, whereas particularly in the 1930s, they didn't even know what to do. But what am I saying? I'm saying there is change. And there's massive change. And when we're all freed, because 4th of July, Boris is saying, is Freedom Day, Independence Day, or whatever, we're all going to get out of lockdown and go drink down the pub and all that, and get our haircuts. So we'll be able to do all of that from 4th of July. But the property market that we'll be heading into is going to be a changed one. So in January, you may have done a little bit of goal setting. You may have been thinking about your goals for 2020 and the years beyond. Those are likely to have to be reassessed. So what I want to kind of throw out to you guys, the panel really, is what are realistic goals for 2020 and the next couple of years in the market that we're going to enter into? And how do you think they've changed since when you were making your plans after your turkey on Christmas Day? Who wants to start us off? Helen?
Sure. Well, my world's completely changed with this, because I spent lockdown kind of here in the UK, as I said, and I was living my nice little kind of semi-retired life in Malta, doing my investing, working with the people that I want to do, ticking along nicely. And it's really changed for me in terms of I kept getting people coming to me who are having problems with either developers or mentors, or people that were having money challenges, getting their own money back. So kind of I've taken a kind of well, I'm doing both now. I'm kind of helping those people out, and I'm doing my investing as well. So that's why I am kind of a lot more out there at the moment and speaking, and I'm even building a website and these things that you seem to have to do these days.
That's an interesting point that you mentioned, because when the market kind of stops its rapid rise, particularly people who are over geared and over leveraged starts to find that the music stops and they don't have enough chairs. And you're seeing that being a fund of developers. Oh,
totally. And I don't think it's any coincidence that everybody's popping up kind of trying to sell more courses, particularly the unscrupulous ones. And, there are some great kind of traders. There are some great courses. I know, you guys run some great stuff. So it's not to diss everybody, but just to say there's a lot of, anxiety's high at the moment. The people with cash in the pocket, feeling that burn in the pocket, so are really looking for kind of opportunities. And I just think everyone needs to kind of take a breath before you hand over cash for training or a mentor or even a deal. Yes, there's lots of deals around at the moment, and excuse me, prices have shot up again in some areas. Excuse me. But let's just, kind of take a breath and not get carried away with any of it, because that's how some of the people that I'm now helping, that's how they got in trouble in the first place. So I think there are going to be lots of opportunities this year. I really do. When we come to the over 100 grand, what we can do with that. When we get to that question, I'm all over that, because that's me. I'm sat here kind of waiting to deploy this, but I'm kind of always long cash, because I like that security of having kind of that money in the bank. So that'll be.
So you're kind of saying that obviously there's opportunity, but it's still a little bit of a wait and see from your point of view before deploying those funds.
Oh, absolutely. I think there are deals to be had right now, but do I think there will be even better opportunities? I was watching one of your videos on the channel the other day, where you're saying, if you spend all your cash now getting in, because this looks like a great deal, this looks like a great deal, what happens when you get, 3, 6, 9 months down the road and the deals are even better?
Yes.
And you've parked all your cash? I
yes.
think if you can, I think it just pays to be, I widely admit I'm a tortoise rather than a hare. But that served me well, each to their own, but there are deals, but be selective. Don't kind of jump into things.
By the way, the reason I said that in that video is because I did that in the early 1990s. I bought stuff which was cheaper 6 months down the road.
Yeah.
And very few people have lived through that sort of investing environment.
Exactly.
And then you kind of know.
Listen to the people that have seen this. I've seen it frequently, on kind of, well, definitely on foreign exchange, but on kind of the stocks and alternative kind of assets other than property. So I kind of speak at it from that perspective, but property is the same. So listen to the people that have been around long enough to see yes. those market movements and what happens.
Mike, what are your views? How do you think you should reassess your goals and strategies going forward?
Yeah, I think I'm with Helen on this one in terms of, I think there's going to be huge opportunities. Number one is I think there is going to be huge opportunities, and I think it's going to be some of the best buying opportunities, we're going to see in our lifetime. I just know in the last recession, I wish I bought more property. So I do think, looking back with hindsight and having gone through something like this before, you can all learn from it. But I don't think there's a rush. I think this has got still some space to pan out. We haven't seen a lot of the unemployment come through. When if furlough stops, what's going to happen to everybody? Are they going to go back to work or not? I don't think everyone will be. So I think things might get a little bit worse in the economy than better. So, but we're going to see a curve, aren't we? We're going to see a bit of a curve. Although where I am at the moment, the property market is very buoyant. So if you're looking for something now, make sure it's a very, very good deal. Don't take an average deal. It's only worth jumping in if it's a very, very good deal.
So how would you define that? For you, what is a, because I come from the viewpoint that if a good deal presents itself, there are certain deals I would do today.
Absolutely. And I'm the same. I'm the same with that. You want to look at what price, you don't have lots of data points for where we are now. And that's the thing, property data points always lag behind a bit. Obviously, there weren't many transactions in the lockdown. So you've got to look at the data points before and then sort of discount that and then get your discount below that. I think some people are just discounting it and thinking, right, that's a good deal. You need to do a double discount, take some money off and then take some further money off. So we're talking, much bigger percentages than most people are normally talking about. If I find a good cash flowing deal that, is 30% below market value, then I would be interested, below the actual value. Certainly, the question though is what is the value today? It is a good question.
It's certainly not the asking price, because a lot of people, base it just based on the asking price, 10% below asking price, and they've got a, below market value deal. But it's not.
Yeah, and asking prices haven't suddenly come down from the estate agents have left them where they are to see what's going on in the market. So again, you've got to look at who's motivated. Is this a good deal? Why are they selling? If it's just a general sale, are you really going to be getting a good deal until people are a bit more desperate? You just have to wait and see.
So I get from you that obviously we're heading into a little bit of a dip here, but there's uncertainty around employment, which I fully agree with. And until that really shows which direction it's going in, it's a bit difficult to plan. But you still know what's an extra special deal that is worthy of doing. And reading between the lines of what you're saying, it's really down to seller motivation, I guess. There are plenty of sellers now emerging whose circumstances are such they have to sell. And it's the need for a sale that trumps getting maximum price.
I think so. This is what I, when I first started investing, that's what I was looking for. I wasn't looking for particular properties. I was looking for circumstances and really the motivation of the seller, because that's where I could then sniff out deals. And I think it's the same again today. You can go to an estate agent, but unless you know what's going on behind, is there really going to be a deal? And then is it genuinely a deal? Helps if you know that someone is actually a little bit more motivated and needs to sell. And too many times I've seen people trying to push deals on someone who's happy to wait. And you should wait, because suddenly you don't know what happens to their circumstances.
Yes. Matt, where do you stand on on all of this? What's realistic to achieve over the next year or so?
So it's very interesting listening to everyone share their thoughts. And I think the difference this time around is that stamp duty rates are much higher. And when I reflect back on the most expensive property I bought like 7 or 8 years ago was a £4 million house in Primrose Hill. And the stamp duty on that was about £230,000, I think, at the time. And we thought that was astronomical. We looked at it and we thought, geez, we could buy another HMO in Reading for the price of that stamp duty bill. But I think now it'd be like 3 times that. Prices are not going to run away. Property prices do not recover and bounce back anywhere near as quickly as they come down. I think there's still a lot of people on furlough. Isn't it something like 9 or 10 million people or something? Like, it's a big number. And some of these people are anticipating redundancy, at which point they're not going to be able to get mortgages. And some of them are buying properties now whilst they can. So I don't think all of the bad news, I think all of the bad news is anticipated, but it's not all out there yet. But Mike's making some good points about how you buy and you buy well. So my rule of thumb is you need the right property and the right vendor and the right circumstances. And unless you've got all 3 of those, you're not going to have a deal that's really a deal. So the right property is something you can improve, extend, change your use, preferably subdivide as well, or do all of the above. The right vendor is someone who wants the money more than they want the property, and they will take the money from you rather than just hold out. And the right circumstances, anything that just gets rid of a lot of the demand. So you're either first in the door before the agents put it on Rightmove or Zoopla, or it's been sitting there languishing. But I had a team at one point I had a team of 5 people sourcing deals for me in an office that was a room like this and another room like that. And I told them on the whiteboard, right vendor, right property, right circumstances. Otherwise, it's not a deal.
That's it. No, that's absolutely correct. And I think you raised some other interesting things in there. I mean, the government have told us that there's going to be a budget, and that budget in October is going to be about recovery. And there's going to be several things in there. One of the big things that is going to be in there is planning reform. They're talking about moving to a zone system, which I think is very, very sensible to allow certain development within a zone. And there's going to be more PD for both residential and commercial. So, and I think that's fantastic news. I mean, if you're doing residential property, when I started buying residential property, I'd always buy an end terrace instead of a mid terrace, because obviously there's stuff you can do with the end terrace if you've got the space. And when you are a developer or an investor, you want to add value. In a static market, you've got to make that increase in value happen yourself. And there's got to be the potential to add value. But what the government, I think, will give us is the right to be able to realize that potential with the minimum of hassle. And isn't that going to be wonderful? Anyone enthusiastic about planning reform? Or do you think it's just that we've heard it all before and it's all more talk?
I think it sounds great in theory, but it's a question of how well the theory translates to the practical, isn't it? Normally you've got to go for prior approval, which means there's criteria that's got to be fulfilled. But no, anything in theory helps that. But instead what we've seen is the government do things with like Help to Buy, which is just a massive subsidy to house builders.
Yeah.
Someone was asking me about this last week, and I've never paid much attention to it because I'm quite happy living in this house here. But you don't need very much money to take use of Help to Buy. And if some of the house builders are a bit distressed in 6 months' time, there could be some really good deals to pick up there, and not much risk either.
Yeah, and I totally agree with that. I think the Help to Buy has been propping up the housing market while it's been quiet for the developers. And, the government needs to continue that to help prop them up. Otherwise, there will be some problems down the line. And I think developers might not see, the developers being in trouble will be a little bit further down the line. But they are coming off the back of a couple of slow years anyway. So, we're kind of seeing they're probably at the last tether anyway. So I think that, talking to developers will certainly be an opportunity. And certainly I've got some plans to be doing that in a big scale.
Help to Sell is a disaster waiting to happen, in my view. It's going to have, because often these properties are premium priced, and when the market turns, they're the first to head into negative equity because there's just nothing there. They're just so toppy to start with. And then you've got a whole bunch of usually people on the first rung of the housing ladder stuck in negative equity. They can't move when family circumstances change and they need to move on. They're just stuck. And the thing about that is, I find, is that those stories drive the headlines, but the investors who look behind the headlines will probably not be looking at those sort of properties. We'll be looking at other second-hand stock in good solid areas with potential to improve, and that will be where the value will be. Have we got a super chat that's come through? Oh, but they haven't raised a question. Okay. By the way, for you viewers at home, when you do a super chat, that means you can ask a question. So John has done a super chat, but he hasn't asked a question. Do that. It goes directly to our panel here. Right. Okay. That nearly interrupted my flow. Sorry. Anything else to add, guys? Goals for this year.
Goals for this
year.
Wait, see. I just think, again, I mean, obviously the world has gone upside down, a bit topsy-turvy for a while, hasn't it? So, but don't lose sight of your overall goals. You need to keep sight of what you're trying to achieve and just work with the new environment and adapt. It doesn't necessarily, if there's opportunities, take them, but also it's okay to push things back a little bit and be patient. But I would say don't necessarily lose sight of them. You talked about, people's 5 years goals. We shouldn't be changing those too much, and certainly not on a regular basis. And we're always going to have ups and downs. And when there's uncertainty, that's when there's opportunity. So, I believe we are in a part of opportunity. So just adapt and be safe. Just be really, really careful in a time like this.
Yes. Okay. Let's have a look at investment strategies then. I mean, there's a whole bunch of things that people talk about, and this YouTube malarkey has meant that there's so many people out there on YouTube, I find, and everyone wants to say something new, and people talk about so many different strategies, and some of them, I know a load of baloney, quite frankly, but that's another topic. But there are a whole bunch of things that work well in a booming market, and stuff that doesn't work well in the current market. I'm just going to kind of precede the discussion by giving my 2 pennies worth, which is, I think that when we go into a softer market where there's value to be had, you don't want to be focusing on controlling strategies. You want to be owning stuff, because when prices dip, what you're going to see at some point over the next few years is the market start to turn again, and prices return to the long-term average. And this is the best time to think about acquiring assets, the best time to get value when you acquire assets. And you certainly don't want to waste time, in my view, on things like controlling strategies like rent to rent, when you can put in the same amount of effort to acquire good stock for the long term. So that's my 2 pennies worth. But what do you guys think? Matt, do you want to kick us off?
Yeah, I'm just plucking up the courage to start a rent-to-rent business. I think that's going to be the #1 strategy for 2020. I'm all over it. No, seriously, we've just done a chart of all the strategies that are out there.
Brilliant.
And it's got all the capital gains up the one side, all the income and cash flow and profits down the other side. And I put rent-to-rent firmly in the corner where there's no income at the end of that strategy and there's no capital gains because you don't own it. The problem with rent-to-rent is, and I'm very happy to be first to put the boot in here, is you got to put some furniture in at the beginning, then you got to fill it up, and then at the end you got to empty it, and then you got to do all the dilapidations, and any profits that you might have made during the course of your tenure as a rent-to-rent property mogul, you hand them back to the person that owns the property. It's a big pile of poo, and it's not a serious strategy. But you're absolutely right, Ranjan. You need to be owning property, and if you can't afford to own it yourself, find someone that's happy to own it and to take most of the capital appreciation and hopefully a bit of profit after you fix it up, and maybe increase the number of bedrooms or modernize the flat a bit. And say, look, you can have the lion's share of the capital appreciation, but I would like the lion's share of the income because that's what I'm trying to achieve. And that makes perfect sense. And there's several ways you can go about that. But that's my 2 pence worth.
Mike, what do you think?
Yeah, I think there's some wise words there. I think, again, opportunities are depending on your goals, because do you want capital? Do you want income? Do you want a balance? So different strategies obviously deliver different things. So as you know, I'm big into HMOs because income is a good strategy. And I think income still is a good strategy within these kind of environments. But over time, you will get capital as well. So I do look at the HMO strategies. I also think social housing is a good strategy over the coming couple of years, having done that before for some very good income. And it's a good way of doing things quickly. Again, you can add value to properties. But actually, if you're looking to buy a few properties, in some ways that slows you down because you're spending a lot of time adding value when actually the opportunities is probably finding the deals over the next 18 months. Focus on finding the deals. So I do like to be able to increase the value somehow. But if there's a massive, development going on, for me, that's just too slow. You want to be in and out with your money as quickly as possible, or working with investors to acquiring quite a lot of properties over the next 18 months, 2 years, as this is such a good opportunity.
What's your view of lease options in these sort of markets? Yeah,
in these sort of markets, I think lease options are fine. I mean, it's a controlling strategy and it can produce an income if done correctly. But also you've then got an option to buy. So you are buying into the capital appreciation. So I think times like these, when people can't sell, is a good time to actually be working these more creative options. And if you've got a little bit less cash than maybe, or not so many investors, these options are quite good, because different to the rent-to-rent side, you are actually able to capitalize if you've got the right contracts in place and make sure you've got the right contracts in place, you're able to take advantage of this capital growth that is going to come. And that's really the big opportunity over the next couple of years. You know, if you go back to 2009, that's, you know, to today, that's been one of the best growth periods over the last 15 years. So, you know, just after the recession, or just in the depth of the recession, is when you're going to get some good capital growth and opportunities to buy.
Yes, yes. No, I agree. I'm a big fan of lease options in a particular stage of the property market cycle, and now really is the time. For followers of this channel, I'll just do a quick plug. We've got a video coming out on Sunday, actually, and I'm grilling Simon Zushi about this very subject, about lease options and applying it in today's market. So make sure you subscribed and liked and bell, and you'll be notified. That hits our YouTube 7 p.m. on Sunday. Helen,
I'm a great believer, though. It's a way, it's a method. It's not necessarily you should just do that.
Of course,
it's a tool that you've got in your toolbox. You know, like working with investors or using purchase lease options. It's just a tool that you pull out at the relevant time. And I hear people saying this is a strategy that you should use, and just to me, it's a tool in the toolbox. My strategy is investing, holding for, you know, getting income, holding for the long term. That's my longer term strategy. It's a tool that we use to actually grab as much property and make some income in the meantime.
Absolutely. And I like to use it where you are doing something, you take the lease option, but you are doing something in the short term, which is uplifting the value. And then you are exercising the option based on what you have put into the property to uplift its value, not sitting around waiting for long-term capital appreciation, because that's uncertainty. And that puts a completely different spin on it. And it allows a lot of people to play in higher value areas, you know, and dealing with the usual retiring landlords and commercial assets and properties that need development and all that sort of jazz. Helen, what's your take on?
The chap said, like, touched on a number of great things there. I think kind of what Mike said then again was the adaptability, as he talked about in the first question. Like, you have to be, you know, it's appropriate for whatever that deal or that circumstance is. I'm very much with Matt on the kind of rent to rent side. That it's not something kind of like I would look at doing personally, because for me, I look at it from a risk perspective. With that, you've got committed outgoings, but you still have uncertain incomings. Like that risk reward has to be so disproportionate to take on that amount of risk. That's just not for me. Similarly, as you said, if you're going to buy something and kind of bank on a rising market, well, you have to have a time horizon long enough and pockets deep enough to be able to fund that on an ongoing basis, such that you can ride the depreciation, and, you know, that shouldn't impact you from a cash flow perspective. But, you know, you have to have the emotional kind of stability to not get emotional about when you see those capital numbers going down and coming back up again. So, like I say, I look at stuff from a risk perspective, and certainly cash flow. And I think cash flow is really kind of it's sometimes kind of not looked at, not anticipated, not planned for in this environment. So that's really something to be thinking about as well.
Now, I mean, you guys have seen the videos on this YouTube channel. Right at the beginning, you get these little ads, and I find all sorts of ads pop up at the beginning of my videos, and people are telling me about how I need to get into deal packaging, because that's such a wonderful thing. And I'm wondering whether they're right or not. What's your view? Should we all do that?
It's deal packaging on a large scale, I think, is a difficult thing to do, because I find that deal packagers who try and pump out and scale up, obviously then they need to find more deals, and they can't always find more deals, and deals are sometimes cyclical, and deals are sometimes this. So as a scalable business, I'm not a big fan of it, but I think to source one or two for other people, you know, actually I found, you know, I have from time to time being passed deals by other people and paid them handsomely for it. And actually that's because they haven't had the capacity to do it, or, you know, it's not necessarily, you know, right, I'm suddenly going to become a deal sourcer. You also need to make sure that you're compliant if you're a deal sourcer. So there's more costs there was, you know, 15 years ago because of compliance and regulations and things like that. So yes, I think, you know, as a way of actually making some money out of deals occasionally, it can be, you know, it's what's been going on in property a long time. Making it a massive source of income and a massive business, I think, is a harder challenge.
My concern with it is that I get sent deals every day. I'm always looking. I'm always kind of analysing and crunching numbers. And I'm not a developer, so I don't have, you know, kind of understand from that development perspective. But even the people that do know it, that are doing this day in, day out, sometimes their numbers don't add up. So somebody that's sourcing, I just find the stuff that I've seen in the past, the numbers really don't add up. There isn't a strong and deep enough understanding of the metrics that I like to know, like, where numbers have come from, where's your GDVs, where's your comparables. There has to be substance to those numbers. And that's what I find is sometimes lacking in a deal sourcer. You know, they get the headline figure, they discount it by whatever, and then it goes, yeah, there you go, there's a deal. Well, is it like, how robust are those numbers? If you can prove that to me, then great, fine. And again, yeah, happy to pay kind of whatever, but there really has to be a deal. And honestly, in 9 out of 10 things I've looked at, the deal ain't a deal.
I mean, I think you're generous at 9 out of 10 there, probably. And also, I think deal sourcing is not an excuse to outsource your due diligence.
Oh.
And I think that is what some people do, and you probably need to do more due diligence on a deal that is sourced for you. And I'd also recommend that you should be looking at areas that you know and have some background knowledge and all of that, so that you've got the depth that Helen is talking about. She's so right. You need to do the depth. And it is so frustrating, even when, you know, quite experienced people are putting things in front of you and there's so scantily information, and you're just thinking, how can I tell? There is nothing for me to tell here, and you're expecting me to invest or buy this as a deal or something. You're very, very correct.
I'm very fascinated how it's sourced, because invariably a package deal these days is a Rightmove link. Is it off market or is it on market? I mean, I've got Rightmove alert set up. If it's on Rightmove, it will come. Matt, was anything to add?
Your comment about off market just touched a nerve, but I spoke to an agent about a week or 2 weeks ago, and he was talking about how he has some deals at the moment. The agents don't want them to be, the vendors don't want the deals to be put, or the properties to be put onto Rightmove and what have you. And he said, we're marking it offline. And I said, I'm so glad you didn't say off market, because when an estate agent tells you he's got something and it's off market, I'm like, but you're an estate agent, how can it be off market? You're giving me brain damage. Can you just go away? But yeah, you're right. If a good deal comes along and you're able to place it, then you should be able to charge a 2% fee. And I've paid fees, and I've passed deals to others who paid me fees as well. But it's a numbers game as well. But even agents who have a deal that's that they're not mandated on, where they're not instructed, will try and pass it on to a buyer and get a fee. But it's about how you spend your time, really, isn't it? And my time, I find my time so scarce. I'm super focused just on my priorities, like for the next 3 months to 6 months, but also for that day, that if I looked at every deal that everybody sent me, I don't think I'd ever get on my day job.
What I've found over the years is that when you do deal sourcing, you will always find a little bit more than sometimes deals come like buses. You know, you got nothing, and then you got sort of 2 or 3, and you can only handle 2 or something. So what do you do with the third? And sometimes stuff doesn't quite fit your criteria. But the surplus deals never come in that sort of industrial scale to make a massive business out of it. So I've tended to use them as favors or quid pro quo. So for example, when I've had private investors, they will invest in a deal on the understanding that I will give them something, pass it their way when the money is we're ready to repay the money, that they can kind of learn from what we're doing on the deal that they're investing in. Then we've found something for them that they can actually invest in afterwards. So it's kind of like, because you don't get many of them, which are kind of surplus to your requirements, you use them to make existing relationships stronger, if that makes sense. And that's been, but to scale it up.
you build up this commodity of reciprocity, which becomes very, very valuable. So last week, someone phoned me up and they said, we've got a great opportunity and it's in this particular area. We need £500,000 of equity. And I said, oh, well, you need to speak to him and him. And they spoke to them. They haven't met. The deal's obviously amazing and they're going to fund it. And that'll be an amazing deal, because if he's given £500,000, there's probably £4 million worth of costs, including the bank debt that needs to be covered. There's probably £1 million worth of profit in there. And what I haven't done is ask them to sign an NDA and do this, and do all that, and do all this. What I have done though is I've said, if this works and you'd like me to do it again, then there would be a fee that's due, and it'll be a handsome fee. But it's a bit like what Mike said a minute ago about having it in your toolbox. Once you know it's there, you know how to monetize these opportunities when they come along. But now the investor owes me one and the developer owes me one, and I've got that in my back pocket.
Yes. Okay, let's just move on, and let me just get you guys to subscribe if you haven't all done so. I thought I'd show off my my subscribe pillow. Press the bell icon as well. We release new content all the time. Good to see so many people on the line. Now we're going to kind of move the discussion on to talk a little bit about what strategies, because this is a question I get asked a lot on YouTube videos. Every week there's several people that ask this sort of question. Haven't got too much money to get started or pursue property. So what are your best recommendations? Matt, I'm not saying you're skint, but what are your recommendations for strategies with little or no money?
Strategies with little or no money. Going to need to use. Someone's got to put some money in from somewhere. The money's got to come from somewhere, right? But little or no money. Okay, rent to serviced accommodation. It does have some risk, but I have seen this done very well. And there's two guys in the club, brothers actually, Toby and Charlie. They've got a serviced apartment business in Bristol called Your Apartment. 160 properties. Their occupancy was slashed when the lockdown happened, and they worked really hard and got it back up to 100%. And 160 apartments in Bristol. I think this even was said in an interview, so it's public knowledge, but they're turning over like £4 million a year. But what I would want to do with that was I would want to use the profits to start buying my own, because on the chart that we've done here, the thing about the rent to serviced apartment is you've got to pay the landlord some rent, and you're not getting any of that capital appreciation. And that's profit that's never sleeping.
Are you just telling people to do rent to rent?
No. But lease, there's plenty of strategies where you can lease the building and make money. People do it with hotels, they do it with care homes, they do it with serviced offices. But the office group, who have a massive serviced office portfolio, some of that is owned and some of that is leased. I wouldn't do rent to HMO. That's like, don't do that. But rent to serviced accommodation is a cash flow strategy.
What is the situation with? I personally don't do serviced accommodation, but with no one sort of traveling much and all the rest of it, what is the serviced accommodation outlook, particularly for the next 3 or 4 months? It ain't go, is it?
I think it looks better than hotels. I think people would rather have their own apartment than using a hotel. Toby and Charlie, I think their occupancy went to like it came right down. It might have been like 60%.
Yeah.
So they got on the phones and they cut their prices and they got it back up to 100%. So but that's also because they really know what they're doing. Like, these guys are sharp. So during the week they're renting to people who are there for business purposes, and at the weekend they're renting to people who are in Bristol for leisure. And by targeting both markets, they're able to get high occupancy. But if you get it wrong, it's not great. But if you own the property and it's your own property, and you're short letting it as well, then you've got the exposure to capital appreciation, and you're turbocharging your income. The lesser example would be holiday lets. So, we've got an apartment. We only have to rent it out 8 or 9 weeks of the year for it to cover its costs, and we use it quite a lot ourselves. In fact, we're off there next week. But that's more a bit of a personal treat than anything else.
Mike, what's your view then? Little or no money, what would be your recommendation?
Little or no money. Yeah. Again, I wouldn't, a lot of people talking about the rent to rent type strategies, invest, but you do have to put money quite often. Everyone gets the cash flow of that the wrong way around, because they invest first and then wait for it to come back. And actually, when you explain it to them, they're realizing that they're working for free for about 18 months before they actually make any money. So if you want to leave your job or something through that strategy, and the bigger you grow, the less money you make at the beginning, because you're just investing. So not a great fan of that. And you need to scale a business, I think, in serviced accommodation to make it massive. You know, maybe a handful of them, or big. Don't get stuck in the middle. But I like lease options. We touched on lease options, so I'm not going to go into big details about that. But I think lease options, if you don't have loads and loads of money, but also to be working with investors. And, you know, the key is to have a good deal. If you find a fantastic deal, you will find people who want to invest in it. And I think, don't think that just because you don't have any money, you can't find a good deal. So I would be utilizing my money in some ways in helping me source good deals. Sometimes it needs a little bit of investment in the right things to source deals. Certainly sourcing deals, and you'll attract investors, because then you could just phone up Matt, and Matt obviously knows lots of people. So, and then you'll just owe him a big favor.
I think you're absolutely right. You got to, if you can, it is not actually that difficult to find good deals in a slow market. And suddenly, if you haven't got any money, then you've got to put something else into the equation, and that's often time. And the thing that's time consuming in deal sourcing is direct to vendor. But direct to vendor gives best rewards. So if you haven't got the money, put in the time to do direct to vendor in a slow market, get that good deal that you're talking about. And if you've got a great deal, there's no shortage of, because Helen, you talked a little bit about due diligence and investors presenting you with scanty information, or the figures don't stack up. But don't you find that if it's a great deal, someone can present to you with a few numbers on the back of an envelope, and you've kind of, you know it's a goer. If you're presented with the right few figures,
you know quite quickly whether it's a good deal. But the key to work out if it's really a good deal is, why are you bringing it to me? If it's been past 10 other people, if Matt's turned it down, if Mike's turned it down, if Ranjan's turned it down, and then it ends up on my table, I ain't interested, because it ain't a deal. So you really have to kind of ask that question, like, ask more questions. In terms of if you haven't got, if there is no money, invest in yourself.
Mm-hmm.
What do you have? So if you have the time, like, there's so much good free stuff out there. There's your channel. There's Richard Little stuff. I go on and I watch his little 20-minute clips that he's doing on his Facebook group with his son Brinley. I know he's a Candor member, good buddy of Matt. I go on that. I'm learning stuff from that. He's doing it's over 100 days, and he's taking people through the development process.
Mm-hmm.
That is gold dust. If you haven't got 10, 15, 25 grand, whatever these companies are charging for training, go and invest 20 minutes per day. Have you got 20 minutes per day to invest in yourself and your future? I would bloody hope so. If you want to be in this industry, go and find, there's so much good free information out there. Look at everybody's pages, the guys that you have speaking, look who's a Candor member, look who's we've got our Property Sisters group that we're just pumping out information on.
Mm-hmm.
It's there for anybody and everybody. There's lots of free stuff out there. Invest the time.
Yeah, but it comes with a little caveat. There's a reason Candor's called Candor, is because we want to discourage some of the hyperbole, because some of the stuff gets put out there. I've seen a lot of people make a lot of noise about a lot of deals that were apparently going to make them a lot of money, and then it goes quiet for a little while, and then it comes out in the wash that apparently their deal was a bit shit, and now everyone's lost all their money.
It's so true. It's really true. I think, you have to approach these with a lot of discernment. And when I do kind of my presentations and talks and stuff, I show people like a tablespoon of salt, and they say people say take things with a pinch of salt. I show them a tablespoon, and then I switch to a slide that's like an industrial, like, salt processing plant, and that's my pinch of salt. So when you're learning, kind of absorb the information, but have kind of a level of, I've changed me and Richard were talking about this. We've changed from cynicism, and we now call it hyperrealism. It's Ray Dalio's word that we've kind of stolen and appropriated, because it sounds a little bit nicer. But yes, that, like, have a little bit of, discernment and stuff.
It's interesting. You raise a couple of interesting points, which I kind of wonder about. There is a huge amount of information out there, and going back to this, I'm very excited to hear what permitted development rights are going to be introduced this coming year. And I tell you, when the first lot of like when office to residential conversions came in 2013, and the first retail to resi conversions. I did my first ones of those projects. I think office to resi was about 6 months after the permission came in. Retail to resi was about 7 months after the permission came in. But at that time, no one really knew about it until about end of 2014, beginning of 2015. Even agents didn't really know about it. And I wonder, it'll be interesting to see when these permitted developments come out in October, whether the fact that there is so much information out there, whether the window of opportunity to make hay when no one knows what's going on diminishes, because there is so much information that's out there, much more than ever before.
Information travels very quickly these days, and we live in a very transparent world. And if you think you're pulling the wool over anyone's eyes, just give it a little bit of time, because it will all come out in the end.
Actually,
Sorry, I've had a question that I need to answer. It's coming on a super chat. It's about we're talking about permitted development. Where can I download a clear list of permitted development rights? I guess you may be talking about commercial property, residential property. I'm not sure which, but if you do a search on this channel on permitted development, there are a bunch of videos specifically on permitted development rights. And when this goes on replay, I will leave a couple of links to some places where you can find a definitive list of permitted development rights. Sorry, someone's asked a super chat question, so I just wanted
there's a list on the planning portal.
Yeah,
changes of use not requiring planning permission. It's on the planning portal. It'll give you a nice table like this, and you'll be able to see it all.
What I suggest people do is, when they want to ask things about permitted development, first of all, go to the source, go to the government website and see what the actual official legal wording is before looking at some random guy on YouTube like me and their interpretation of it. Look at the source first, and then look at the interpretation by others. That would be my tip. So it is all out there on the government website. Okay, so have we talked about? In terms of little or no money down strategies. I'm going to harp on about lease options again, because I'm a big fan of those sort of. What we're not talking about going up north and negative equity hellholes and all that sort of stuff. But what I'm talking about, I'm working with someone at the moment who's buying a 12-room HMO off a retiring landlord. And again, that's on a lease option, because the whole strategy is just based on putting en suites in everywhere, doing it up, bringing it up to modern spec, increasing the rent roll, and then exercising the option based on that uplifted value. And the thing about those sort of projects is that if you think about it, if you wanted to buy that 12-room HMO, this is in London, you would need a huge deposit to do it normally. And the kind of people who have got that £300,000-400,000 typically to invest typically don't want to buy an HMO. So you end up with vendors like this, which have got a sizable asset, which kind of only appeals to someone who's putting forward a creative way of buying it. I'm not sure whether people fully twig how that there are these genuine circumstances to pick up great cracking properties at times like this, because there aren't any other people interested. Mike, is that something that you can relate to?
I'm nodding a lot there, Ranjan, because it's exactly what I do. As I find, I work with landlords who want to get out. And it's a strategy for all times. I think this time will be even bigger. Section 24, people might have had some scares and thinking, oh my gosh, I've been working for all this stuff, I might have lost it. Financing could be some issues later on. So I think this is even better than normal. And I find them normally. And it is about working out what the landlord wants. And there's an opportunity, as you say, to add value, maybe create more rooms, en suites, just do it up to modern day standards. You know, the number of properties I've seen that are uncompliant, you know, and landlords don't know that. So there's a real opportunity. And I think you're right, you know, especially a big HMO, they're hard to sell. People don't realize they're hard to sell. They're hard to buy, they're hard to sell. Hence why they're hard to sell, because they're hard to buy. So many questions, large deposits, all of these things. So they really open themselves up for creative buying strategies. And they are one of the best. And also, if you can take the cash flow on quite quickly from these properties, you're making money quite quickly. And that again is better, because you're not investing and working later. You're getting money, you know, quite early on in the investment stage without having to invest loads up front.
Yes.
You know, you need good paperwork though. And, you know, I'm nervous at spending too much money because it's not my property. But, you know, as long as you've got the right paperwork and have some confidence, you can do that.
Yes. I mean, obviously you've got to get the right advice and all the rest of it, but it's the idea that I want to get across.
Absolutely. The idea is spot on for me. And it's certainly some of the opportunities I'll be looking for over the next year. But I think there's just going to be a lot of them, and you need to be clear on what you're looking for and how it's going to help you, and not trying a scattergun approach and just go, I just want opportunities. You need to focus in, like in life, be clear, have clarity. You know, where is it that you want to invest, and what is it, what type of property are you after, and look for those kind of things. Yes. And, you know, utilize the strategies out there to source those types of things. You know, there are many different sourcing techniques. And again, this period of time, direct to vendor stuff, I think is going to be very good. And then, as Matt was saying, is it on market, off market? Quite often direct to vendor stuff is off market.
Yes.
And that's when you have time to talk to the landlord or the seller and build a relationship and actually find out what his or her motivations are. And you can tie that in with some creative options, or just buy it, you know, if you have the cash, or an investor.
And of course, I mean, moving on, at the other end of the scale, there are people with some money. And, you know, when interest rates are so low, I meet a lot of people who act as though having some money in the bank is actually a massive problem. You know, it seems to be sort of burning a hole there. They're very, very impatient to go out and sort of spend it on something. But I think, you know, there are a whole bunch of strategies for people, you know, who've got a little bit more to invest. Matt, you look as though you're a guy with 100 grand in the bank. What would your advice be to someone in that situation?
Well, if you've got the experience, you want to leverage it, right? Take your 100 grand, go and get another £1 million from an investor. Use some sensibly priced debt, not take too much planning risk. All those sorts of things. I think if money isn't a problem, then you're unlikely to want to work very hard, because presumably you finally got yourself in a position where you don't have to work very hard. And the whole point then is that it gets onto what you call return on energy. And I was using that for a while, but then it's kind of Ranjan's term, and I don't want to nick it off him in case he trademarks it or something. But I like to call it return on work. And it's hard to beat, you know, some of these commercial properties, if you just want to go straight investment, 5 to 9% yields at the moment, and good tenants like Co-op and all the other convenience stores and what have you. I've got to say, I think that looks really appealing. I previously had 80 tenants in a portfolio in Reading, and I had a property manager that looked after it all and everything. There's quite a lot of responsibility that came with that. When you rent an HMOs to professionals, you are constantly having to top up the empty rooms and do that sort of thing. Whereas HMOs for students, you just got to rent them once a year. That probably makes more sense to me. I've got friends who've got large HMO portfolios that are just for students. But it's the return on work, or as you call it, the return on energy, that then I think becomes important. Unless you're really ambitious and you're trying to make a lot of money, in which case you're going to have to leverage up with an investor like Helen, who's going to probably want a little bit of skin in the game.
Oh yeah.
No, I think you've answered the question very well. I mean, if you want, it's very good that you've highlighted the return on energy, or return on energy, really. Because if you've got 100 grand in the bank and you've got tons of energy, then leveraging that up, using that to raise more money, and doing some stuff that will involve a little bit of energy will get massive results. But equally, if you haven't got that appetite, then there's lots of simple stuff you can do for returns that are a lot better than, and a lot safer than anything else, such as certain commercial properties. I mean, Helen, what would your advice be to people with a little bit of money to deploy?
I mean, this is where you really need to know yourself and what you want as an investor or a private kind of investor. Is kind of security. Are you kind of low risk? Are you risk averse? I'm kind of at that end of the spectrum. And certainly you find it with older investors. They're at that point of the life where actually they don't need to be tripling their money overnight, or, go for get rich quick stuff. Capital preservation is their main driver. So if that's what it's about, look for the security and ask for how the deal is secured. What that basically means, what can you chase if the deal goes wrong? So if you're going to put your money kind of in as a JV in an equity, if prices tank and that deal goes wrong, your money is the first that gets that gets wiped out. Like, risky. Go for something that's asset backed and that's secure. So first charge loan stuff, I've been doing a lot of those. So I started out with equity stuff initially, kind of like about 5 years ago. And I realized because of the time and, because of the market that we were in, that development was taking, I was getting first charge or second charge type returns, but I was taking equity risk. And for anybody that looks at kind of the capital stack, I did a little piece on LinkedIn. What I'm looking for is the return has to be appropriate for the risk that you're taking. Now, actually, I'm at the point where I want a higher return for the risk that I'm taking. So I'm trying to get a bit clever about it. But if you're kind of, this is you're just looking at this, beginning to look at this stuff, kind of first charge asset-backed loans every day of the week. And I'd say now there are some really good kind of opportunities like that. But first charge means effectively you are the mortgage for that property.
Yes.
The legals and everything has to be very tightly wound up. But somebody stops paying you or they don't pay you the loan back, you step in and take that property. Now that's not like kind of a fun process either. So
have you had to do that?
I haven't yet. She touches wood quickly.
Same here.
I haven't, but I have done a lot as because I'm geeky like that. I have done a lot of research about what the steps would take, because I don't want to be in a position where somebody defaults and I'm suddenly like, bugger, right? How do I start? Where do I start? And I want to know what those steps are so we can go, right. I mean, obviously you try and work it out first, and if you can't, then you go down the process. But that's where, again, being very selective about who you deal with, kind of comes into it. Be very selective about your partners, and will they do right by you?
It's not a quick process. And also, if you are the first charge holder, you'll suddenly find out how much receivers charge. I lent someone some money because they totally ran out of cash, and they had a piece of property in the south of France that was worth 8 or 9 million euros. It wasn't even a property. It was a piece of land with planning permission for a 9,000 square foot house. And I thought, well, this has got to be a safe bet. There's 50 grand so you can feed yourself for the next 6 months. And they totally ran out of money. The architect slapped in a notice to wind them up because they hadn't paid the architect. And it got very ugly very quickly. And that 8 or 9 million euro piece of land got sold off for 3 million euros.
Wow.
And I think it's ongoing with them. And finally, I've had my money back. But you want to stay out of all that stuff. I've got a list of bad strategies here, actually, Ranjan.
Go on, go for it.
Number 1, rent to rent. Number 2.
I agree, yeah.
Number 2, hotel rooms. There's no second market. You're not going to flog it on. And it's probably a mini bond, and you probably don't have any security. You're lending it to a company that's got no balance sheet. Care rooms for the same reason. Student rooms for the same reason. Anything under £40,000 because you can't get a mortgage on it, and you need to get some debt in there to get your returns up. And off-plan property is pretty risky. You've got to be prepared to lose your deposit. Those are my bad strategies.
Yeah, no, I'm pretty much agree. It's completely the wrong time for off-plan. You didn't add deal packaging in there. Rent to serviced accommodation and all of that. Okay,
no, serviced accommodation is all right, Ranjan.
He said rent to service accommodation is all right.
Yeah, he did. But surely not right now. You've got to wait until people can go and travel around again.
No, there'll be loads of people who are fed up with the rent to service accommodation because they haven't quite got it right. And whatever you're doing, you're better off owning it. And
I think it's like all these things, though, isn't it? If something is done well, you can make a business out of it. So you can make a business out of rent to rent. You can make a business out of rent service accommodation. Whether it's the right thing to do or not, I don't know. But you can make a business out of it. If you've got low enough, the problem is with rent to rent is you've got too many mouths to feed. I think that's one of the many problems. But you've got too many mouths to feed because the landlord probably has a mortgage, so that needs to be paid. Then the landlord needs some profit, and you need some profit, and then there's a tenant that needs to pay you. So there's too much in the profit stack. So your margin
in the trough.
Yeah, and then what you don't realise is that it's a bit like the developing and the equity stake. Is all your money comes from the top end. So the only time you're making money is when you're completely full, and everyone's often too optimistic with how full they're going to be. So you only make money then. And when you don't make money, it's not just, I've lost a little bit. It's like, bam, straight into the red. It's a very sensitive model, is rent to rent, because your costs are often so high because you're paying too many mouths.
Better off being an Uber driver.
Here's what I find fascinating about rent to rent is when you actually talk to people that are doing it, the reasons why they got into property in the first place is because they actually wanted the lifestyle of their rent-to-rent landlord. Their rent-to-rent landlord has actually got the lifestyle they desire.
Someone came up to me and said, I'm off on this rent-to-rent course next weekend, and I'm going to build up my rent-to-rent business, outsource everything, become financially free, and leave a legacy to my children. I said, I'm sorry, sweetheart, but you are the outsource. And I popped her little bubble. I didn't like doing it, but
glorified letting agent, basically. Helen, you raised some interesting thing about lending, because a lot of people come to Baker Street events, and people say to me they met someone at Baker Street Property Meet. They pitch them with a sort of a lending proposal, and some people show me their paperwork, and what I get sometimes taken aback by is that sometimes someone with 100 grand in the bank will actually let the borrower draft the paperwork. When do you go to a bank and borrow money and you give them the paperwork and say, right, okay, this is my paperwork? They give you the paperwork. And sometimes I am amazed that when they give me the paperwork, I say, well, where's the rest of it? Because it's only 2 pages long. I mean, no loan agreement of mine is less than 15, 16 pages, because all the stuff that happens if it goes wrong is documented there. And I find that some people with some money, they like the idea of investing in a deal. They've seen Dragon's Den and all these other programs and all the rest of it, but they don't really fully understand the risk equation and where they are getting in on that deal stack. Do you have any quick fire tips for folks like that, Helen?
Absolutely. You hit the nail on the head with the agreement there. Like, it should be your agreement. By all means, take theirs and have a look at it, and get a solicitor to look at it. People think, oh gosh, I don't want to pay £300 or something or whatever it's going to be for a solicitor. Gosh, that's a lot of money. Let me tell you, you pay now or you pay at the end when the deal goes wrong, and it's going to cost you a lot more then. We did, I don't know if anybody saw the video that we did with Claire Norwood, where it was a very unfortunate incident with a mentor. She was trying to put in legal agreements retrospectively. It cost her about 10 times as much as it would have cost if she'd done it right at the beginning. And I've looked at stuff before. I'm like, where's the default rate? Albeit you have to be careful about that. Where's the default rate and where's the end date? Like, fundamental bits of these agreements are missing. Yeah. So definitely speak to somebody who's done it before, who can guide you on that stuff.
Anything to add, guys?
Yeah, anyone comes anywhere near me with a loan agreement that's got no repayment date on it is going to find out very quickly how out of order that is. I've got a very dim view on that.
Yeah.
Also, actually, I would add, borrower pays. You don't go to the bank and the bank says, yeah, we'd love to do your mortgage. We'll just go off and pay our solicitors loads of money and hope that it works out. The borrower pays. Yeah. And it's the same with us, and it's the same with institutions. Borrower pays.
And also something that Matt said earlier is something that's really important. Like, you have to prepare for the worst case scenario. You know, you might like this person. It might look like a great deal. Yes, you've got a first charge. It should all be wonderful. But what if it's not wonderful? What if they don't pay you back? So you need to know, basically, you know, just because it's a loan doesn't mean there's no calculations to be done. How much are you lending against the security? You can't lend what the whole value of what you're lending against is worth, because exactly in the instance where you need to go and chase it, you know, there's going to be a fourth seller, there's going to be all the fee takers to pay. So if you've lent 100% of the value of that's just frittered away. So you've got to make sure what you're lending is recoverable. It's proportionate and recoverable. It's a really good point.
Yeah, there's a real risk and reward balance going on here, and I think people just don't understand that seesaw of risk and reward. And they see reward, and right, like, it's a bit like, oh, this is a deal. It's a bit like the reward. Oh, this is the return. Yeah, but why is that the return? What risks are you taking for that return? And you know, there's a reason sometimes why returns are what they are, because there's associated risk, and you know, and it doesn't always correlate, because it's not. You need to understand what the risk is, as Helen's saying, and you know, some of those things that she said are spot on. But definitely risk and reward seesaw. You want to get that right, that you're comfortable with, and I think ultimately people are probably more comfortable with less risk than they believe.
Yes, absolutely. And I think I'm a big fan of Warren Buffett. I can never remember his quotes exactly, but words to the effect of, first rule of investing, make sure you get your money back before you look at the return. And I think that's important, because some people are very influenced by 20% returns, you know, but they're not looking at, well, are they likely to get their capital back? That should be the first thing, and really the only thing, really. Otherwise,
first rule of investing: don't lose your capital. Second rule of investing: don't forget rule 1.
Summed it up very nicely. Yes.
The problem, Ranjan, is that a lot of people think that 80% doesn't look that risky, but when you look at the paperwork and you understand the actual deal, the real return that's commensurate to the risk is more like 30 or 40%. No one's going to give you any money if you ask for 30 or 40%, because they think it sounds too risky. But you ask them for 8 and they'll give it to you. And that's what happened with London Capital and Finance. 11,000 investors or something like that, all putting in their ISAs and their SIPs and their pension and their savings, because 8% doesn't sound so bad. And that's why there's a £230 million insolvency at the end of the party. So you need to know what the return should be, not necessarily what the return is that they're asking for. And that's the trick.
Yeah. Go and read my LinkedIn article, and actually the lovely Manish Kataria from Invest Like a Pro let me use his graphic, and it talks about the capital stack and what kind of returns are appropriate for what risk. It's not widely understood.
I saw that. We'll put a link in the description if you're watching it on replay. Do you think there's going to be over the next year? Do you think there's going to be a little bit of an issue with people that have taken money from private investors, and basically private investors finding they're not getting their money back? I mean, I think in a rising market, that really covers a multitude of sins, and it covers people, really.
Yeah.
When things stop.
Me and Matt are looking awkward there, because we know things that are going on kind of behind the scenes at the moment that we can't talk about. And yes, there's a lot of.
We all do. I'm trying to trap you. I'm trying to get. I want an exclusive on the line.
He's trying to prod us. Helen.
I'm trying to prod, gently prod.
Obviously, you've got to look at the marketplace and what's going on in the marketplace to see how things have slowed down. And obviously, there's not much happened in the last 3 months. By the way, I don't know where you guys have been, but not much has been going on in the last 3 months in terms of property sales, which often is where people get their money paid back or refinances. So you know, you've got to look at what's going to happen over in the future. Obviously, you know, one of the things that's just recently happened is obviously there's a lot of liquidity in the market with all the government loans. So that might have extended situations.
Mm-hmm.
But as I said, things might get worse before they get better. Who knows? But we've just got to sit tight and look. But it, again, how are people paying these things back? What's going on in the marketplace, really?
And it also comes there to something I talk a lot about communication. Like if your developer or whoever you've lent this money to disappears, stops communicating, that should ring alarm bells. It really should.
You don't think it's because they're in a bad signal area?
Well, let's give them the benefit of the doubt. Like that might be all right for a day, a month, 2 months, 3 months later, and you still don't know where your money is or when it's coming back.
Yeah. No,
really, you need to be asking more questions, and you need to be forewarning your solicitor to get ready.
I think if anyone offers to give you 10% per annum for a personal guarantee, the next thing you should ask them is, are you a Ponzi? Because it sounds like you could be, because you're taking unsecured debt from people. You're not giving them any charge over any assets. You just keep taking it. And if anyone wants their money back, you just need to take it from him and give it to her. Yeah. And 10% per annum with a personal guarantee, the first thing you should ask is, like, normally that sounds like a Ponzi. Can you show me that you're not?
And if you do hand over your cash, you're a Ponzi.
No, I think it's actually unfair to blame the investors. I go through different cycles, like it's the investors' fault for not knowing what they're doing. But I don't know how to wire a house. An electrician could come around here and tell me he's done the whole thing properly, and I wouldn't know because I don't know anything about it. But I've worked in finance, I've done my own deals, I've been an investor, I've borrowed money from people. I do get this, so I can understand how people think like 8 or 10% sounds good, but you've got to have some proper security, and there have been lots of illiquid operations that have been getting washed up over recent times, and the experienced people see that happening way sooner than everybody else finds out, because there's always telltale signs. They spend the money like it's someone else's, not like it's their own. They're giving PGs and take money at 10%, which is not proper security, and they do shit deals. Sorry.
Yes, I know. There's all sorts of hoo-ha, and again, quoting Warren Buffett, when the tide goes out, you see who's been swimming in the nude, and a lot of nude swimmers are going to be exposed in the property world over the coming year. But that's a little bit of noise that will happen. But the underlying thing is that I've lived through a few of these recessions, and the biggest opportunities are in these years. And I haven't managed to top the deals that I do in times like this, in boom times, because it's a lot harder to do barnstorming stuff in good times than it is in these.
Actually, Ranjan, I think you set a good example, because most of the people who I know who are successful in property have got some business on the side, whether they're running a construction business or they run an architect's practice or they're brokering debt or whatever they're doing. And when the sun's shining and it looks like there's good deals to be done, out they come and they do the good deals. And the rest of the time, they're getting on with running their business. And I think that's the right way to do it. So, because you're right, there are times when it's great times to be doing deals, and there are times when you should just sit back, because I wish I'd sat back in the run up to the Brexit referendum, but I was trying to pursue my peers who thought, I thought they were all doing really well, and I scaled up to try and do 12 million quid worth of property, and then we voted by 2% to leave the EU, and the tide went out.
With that graphic image in mind, it's time to say good night, and thank you very much to our guests. I'm not going to give you much time to think about this, but from all of you, share with the audience a tip from you guys for navigating their way through the year ahead, starting with Mike, and then go to Helen, and then Matt, because that's the order I'm seeing you on screen.
Yeah,
share with the audience your tip.
Be aware, be patient.
That sounds like Boris. Be alert.
I was also about to say be alert then, but you stole my thunder. Thanks for that. Invest, don't invest. Invest, don't invest. No, it is about, there is no rush. Everyone thinks there's a rush. There isn't a rush, and you will know a good deal when you see it. And if you can't see it, it's not a good deal. Yeah, you will know. I mean, even Helen said quite quickly, she knows if it's a good deal. Of course, she'll go off and do the due diligence to support that later. You know, she'll delve into the detail, but quite instinctively, you will know if this is a good deal or not. I see too many people trying to make deals, fit deals, squirm spreadsheets. So just wait for the good deal, because it will turn up, but do the work to make sure that the good deal will turn up on your doorstep.
Yes. Helen, what's turning up on your doorstep?
It's kind of a similar thing. We all talk about, you know, looking for motivated sellers, and that's, you know, we should, but don't be a motivated buyer.
Yes.
You know, there is, if you are sat with cash in your pocket, I'm feeling your pain right now. You know, it's there are kind of opportunities, but there's going to be more. So again, don't be too eager. And my staple is take everything with an industrial mountain full of salt. Just keep asking questions, but why? And get them to justify. And if people get awkward or defensive or won't ask you questions, again, like, ask why and be prepared to walk away.
And Matt, any salty advice or words?
My salty advice would be, do good deals or don't do deals at all. So be mindful of basements, fourth floor walk-ups, anything that's not got planning, or not like a piece of land that hasn't already got a property on it or something like that. Property is a great side hustle. It's the #1 wealth creation strategy. Buy good property that's going to go up, refinance out big lumps of cash, and do fun stuff with it, or buy more property or start a business. And that would be my best advice.
I mean, yeah, I mean, you've summed it up well. That's pretty much it, isn't it? That's pretty much the recession strategy. I mean, my advice to you guys is like, subscribe, comment, keep watching, keep learning, and follow what these guys have said, because I endorse all of that. It's all good. It's all good practical advice. Our next live stream is Wednesday, 29th of July. Our guests are Hanif Khan, Jay Howard, and Claire Norwood. More property chat on a range of topics. This Sunday on YouTube, I'm grilling Simon Zushi about lease options and applying those in the current market, so stay tuned for that. Thank you all for joining me on this wonderful night. And
Thank you.
My idea, Helen, with the wine. Tell us what you thought about this live stream in the comments. Thanks very much for encouraging words that we're getting on there. And see you all next time, folks. Bye for now.